I'm Benoit Paliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And we've received some feedback around doing this video around frequently asked questions from our clients in the past quarter. We've had a few. The first one is underperformance, some concerns. So the NASDAQ and the S&P 500 are rocket ships, and the portfolios haven't kept up with those two indices. So we'll look into why. We've had some clients simply wonder whether or not we should go to cash, whether it's because of election concerns, because we had a pretty big market move up from the lows of March, or fear around a second wave or so on. So we're going to address that question. Diversification versus diversification. So we're going to talk about how, as portfolio managers, we build a diversified portfolio. However, it does impede on the performance. There is no doubt about that. That's why we call it diversification from a performance perspective. And COVID-19, the unprecedented time. So is this new? How do we deal with it? Let's talk about the underperformance questions. So some clients have asked us, why is their portfolio not keeping up with the published indices, largely the US ones? For those that are new to Exponent, it does happen. So in this case, it happened for two reasons. We strive to provide a consistent return and focused on the dividend-paying universe of the stock market. Lower and effective 0% interest rates have the most benefit to assets that are called long duration. In other words, that will that will pay the investor a long time from now. In the world of equities, the stocks that have the longest durations are technology stocks, or stocks that have a much brighter future than the current fundamentals show. They might be losing money right now, but they're investing for the future. So expected profits, or the growth of these profits, or even the growth of the sales are well off into the future. So when rates are low, investors will discount these cash flows. So the terminal value, let's just say the future profit or future value of the company is really well off in the future, and we might even have negative or a very small future or current cash flows until the quote-unquote future. So that's why we tend to underperform when interest rates go down like they have. It has an overwhelmingly positive effect on long duration assets. The formula for the cash flow is the summation of the future cash flows. So the R is the interest rate. So as interest rates fall, mathematically, the discount cash flow goes up. So the second reason why we stay away from these sort of, or not stay away, but have less exposure to those sort of high growth situations is that we build our portfolios to lower or to have manageable volatility, because all of our clients are private. They have a finite life. They have cash flows they need to meet. They need to retire on this money or fund future endeavors. So we did outperform on the downside in March, but the rebound was so violent, we simply didn't keep up. And that rebound was largely in technology companies. So we did build portfolio with some exposure. We simply did not have as much as the benchmarks did. So as we mentioned earlier, the benchmarks are really seeing their top holdings becoming technology companies. So let's have the question about, let's go to cash. So a few clients, and in fact we are always conscious, but a few things to remember about taking a binary outcome to things, meaning going all to cash. We get worried when everyone is positive. We really get worried when the common narrative is one full of optimism. And right now, we can't say that it's full of optimism. I can't even think of a positive headline to come to boot. Maybe increase or better than expected job creation would be one, but really it's not to say that it's all steam ahead in terms of good news. Doesn't mean that we're all steam ahead when the news is bad, that we're all steam ahead in terms of deploying the capital in the markets. We still have significant cash. But going 100% into cash or 80% or a significant way is probably in our way a rash decision, and we want to make sure it's not emotionally driven. You got to, because remember, you have to get the timing right twice. You have to sell at the right time, and then the implication of the sell is that you have to go back in later on. So you have to be right on the way in or right on the way out, and then right on the way in. And very few investors get that right consistently. So the chart I have here, we probably have all seen before. I mean, at the end of the day, it's basically if you don't mess with a portfolio from 1990 to, and granted it's a long time, it's 40 years, but if you've missed the top 10%, top 10 days or months and top 20 months, this is how much money you would have. So missing the up months is very much detrimental to your wealth. So really, we'd rather tilt the exposure, moving from, say, 100% invested to maybe 80 or 75%, based on a whole host of factors: valuation, current market conditions, whether it's euphoric or fearful, or short-term anomalies. Sometimes, like right now, real estate and oil and gas sectors are really, really cheap. Doesn't mean that they're going to get expensive overnight, but we can see the value there. So we abhor we want to stay away from making binary decisions like all cash or all equities just on a feeling or intuition or gut instinct or some interview that we saw with a quote-unquote market expert. The cash question is really about risk control. We do that by getting the right weights, watching valuations, and make sure that we buy the quality companies the best qualities we can find. General markets do matter, but they don't really have that much more of a weight in deciding whether or not to go to cash or in terms of the deployment of capital. So diversification versus diversification. So here we've got two charts. I apologize for the fuzziness here. So what we've got here is the S&P 500 and the RSP, which is an equal weight of the S&P 500. So the point here is that the market on the RSP, we're still below currently the pre-COVID levels, where the non-weighted, so the regular RSP, the SPY or the S&P 500, is above the pre-COVID levels. Same names. The only difference is this one's equal weighted and this one is market cap weighted. So what's fascinating to watch here is that the weights that you have will have a pretty big impact in the short term anyway in terms of how your portfolio behaves. So COVID-19, we do a lot of research. There's a lot of people that pretend that they're the experts. We just went through, I want to share with you a few of these links. I'll leave them up for you. If you want to do some more reading about whether it's the WHO's World Health Organization's COVID page, all the data that you can slice and dice about it is on there. And then interesting stories around the polio vaccine, how it transpired, how it came about, how it wasn't a linear outcome, or I should say a binary outcome. It's not like the vaccine came out and then everyone got immunized. Far from it. There's another great website called The History of Vaccines. So it's really a history, a timeline, if you will, of different vaccines, but also different viruses from the year 1000 to today. I would invite to see it. It's really a fascinating webpage. It's well done. The other is sort of a WHO page as well, but on HIV. I learned a lot about that. I didn't realize that the HIV virus was still as prevalent in the world as it is today. A few more articles around viruses or vaccines and how they come about. So I'll leave these websites here for you, and you just click on them straight from this presentation, or just copy the link. Thank you very much for watching. If you have any questions or comments, please drop us a line. I'm Benoit Paliquin for Exponent Investment Management. Thank you for watching.